responsible for the whole our company, for adoption, and for deciding how we execute that and things like that. So this was
喂，
刚才之前就出问题了，重新启动了。也
是机器出问题啊，出现技术问题啊，
不知道什么
问题了
哎，你在这里吗？
啊，
我看着你啊。哎，没看到你。
影片设置中你看不见，我这边有摄像头，我这电脑没有摄像头
你在这里
啊，但我能看见。
你可以录啊。
啊，
你现在可以录了。
我可以录啊，试一试。
我们要录制吗？
啊？
哎，现在可以，能听见哈，能听见了哈，能听见声音了，
听得见吗？
能听见声音。要录了啊，
录起来了。
啊，录了。
哦。
现在买了油了。
能听见，能听见。
Your dedicated advisor will work with you on a comprehensive wealth balance and across your full financial picture. A plan of 10 smart investing strategies designed to help you keep more of what you earn. This is the retirement plan.
She has no idea she's sitting in a gold. She doesn't know that if she owns a life insurance policy of $100,000 or more, she can sell all or part of it to cover the cash to the term policy. The term policy. Find out if you're sitting on a gold index. Call Compensation today at 800-476-0100 or visit compensationindex.com. So, why should you like me? I'm a hard worker with a 5-year plan. I like whatever sports you do. So, I said the phone this. All I want to do is take your daughter. Never wondered if people with all the countries put all the answers as smart at compensated policies. One person can cause an effect. One person in Asia can challenge outdated hiring practices, champion aligned benefits, advocate for pay equity, and experience now into the business. HR empowers to
And certainly we want to And that's what you
consumer staples, healthcare, which have also done very well recently, underperforming today, although again, the idea here is they want growth. Just look at some of the stocks associated with speculative associated with large clients. So you see big moves up here, movie software, Block, Zscaler, Roku, a lot of names were just closed not long ago, have a big move to the upside today. And it's not just speculative tech, it's smaller tech, if you want, larger cap techs to move rather strongly today. A lot of software like ServiceNow, Autodesk, Paycom have been very, very strong, along with semiconductor folks, Advanced Micro, and NVIDIA. And it's not the big cap, other big cap tech, Apple's up 6%, Microsoft's up 5%. It's just that other parts of the tech world are outperforming even the big cap companies. The other sector that really knows what we're doing today are housing stocks today. Remember, they went horrible for 10 years due to COVID and higher rate expectations that really materialize. You look at Lamar, Portland, and stuff associated with housing like Mohawk Industry and Sherwin Williams also outperforming. So there are, you can't help but think that this whole story here with the CPI maybe reframing the debate a little bit, but because of this major industry, how they've been using recently. So we have the VIX at a 2-month low right now, we have a dollar index at a 2-month low, with two indicators, the move of the market, 9% off the high, 4.8, 4.4, so lower for the whole week. That's a notable week, and that's a big part of the response thing. So the question is, some goals are trying to use the players, maybe we'll get a soft landing, but bring back that place. Right now, what's next to the market here is, remember, the question here is most esteemed for earnings here. And the bulls are trying to argue right now that maybe if this change of opinions, once the stability in 2023 ends up, some of the people anticipating the earnings will come down dramatically, maybe not. Maybe earnings are confidence will in fact not happen again. And if you just have it stable, we think that an expansion of the multiple now is about 16 times forward earnings. But if the economy is not going to crash, you could argue for a higher multiple, maybe 17, maybe 18. You see the estimates broke down. If they really go into negative territory, still up to traction for the fourth quarter. Technology and communication services are moving to the downside. Their estimates are down, but overall, we're still holding up. And 2022 numbers, they're up 5.2%. The bulls are arguing right now. Stability there is less upset in the multiple premium that we can get. Finally, go through that 3,900 level. Right where we're at, we have a lot of trouble before. All that's good. Thanks very much, Bob Summit. Not so long ago this morning, I was at the best deal with David and Sam, and considering our family. And by the way, Sam Baker-Fried of FTX published a remarkable Twitter saying about the financial distress that FTX is under. Saturday about the overall pressure in crypto. Basically, a giant view of Papa. I'm sorry. I guess the biggest thing, I should have done better. Goes on to say that so we are where we are. It sucks if that's on me. I'm sorry. Says his number one priority by far is doing right by users. And I'm going to do everything I can to do that, to take responsibility and do what I can. Can't make any promises, but I'm going to try. We're going to say that every penny of the existing formula will be sent to users unless they are still being right by that. But all of that isn't what matters right now. What matters right now is trying to do right by customers. And that's it. We talked about sort of the ramifications of acceptance so much so early on in the process. Yeah, it's extraordinary in some ridiculous because the way that you communicate exactly what legal advice is getting. But there is the potential here is the fraud. I mean, they typically count for the research. The NPN, the count for the research. Again, we don't know. We're speculating based on other reporting and say, I'm going to people who are aware of it. How it goes like fine, FTC the point is by FTX on leverage, and then taking that back and putting it back in the FTX platforms. That's not that's the was shouldn't take place at all. Is exactly again the relationship with the parties. So whenever it's like in the fourth wall, it always shows every single collapse or potential collapse. And I would just direct people to, let's see, number 5 here. In terms of this heat storm, the first time, according to the rules, that internal label and the technical rate was counts, but I was substantially off in my sense of communicating margin. I thought it was way lower. So we also didn't understand how much leverage the own customers had. And what that platform. It goes on to say right now, our liquidity range, leverage is 1.7 times, our liquidity goes 0.8 of the Sunday's withdrawals. $5 billion was withdrawn on Sunday. That was the largest so bank with by a huge margin on Monday. So I was on twice. Spoken a lot of sense. Basically, wasn't very good at what he was doing. And then I saw so it's all because Friday was missing. And then I know that, for example, the Galaxy going on swap as well, trying to defend the underlying use cases of the technology. So this words were that FTX is no more crypto than webcam was the internet. I'm trying to say that there's still usefulness in this phone down the road, but as it always has a body for the and everyone may be the case. And for crypto overall, the importance of that. MSJ system is one of the most particularly not referred to often. So many of those other platforms are not. Let's find out where it's what we saying moments ago, to keep the idea that it is a welcome relief, but there is still a long way to go. And there's a process of bringing supply and demand back into balance, and I quote, is just getting started. Now, Logan is the former head of New York State's monetary policy desk, so we watched closely her comments on financial markets. She says liquidity conditions in markets have been strained, but suggests those strains stem more from uncertainty and volatility. Doesn't have all that concern at the moment. She added the Fed should avoid costs that are higher than necessary to be attentive to risk of further policy tightening. Finally, she said it may soon be appropriate to slow the pace of rate increases, and that's along with other Fed comments that we got in the past 24 hours. Shirley Evans, the president, saying he's nervous about risk to the economy of bringing rates too high, but Neil Kaspari, a little sterner, saying talk of a pivot, quote, is entirely premature. Patrick Harker earlier this morning saying we expect we will slow the pace of rate hikes in the coming months. Everybody talking about the CPI data, 0.2 better than expected on the headline, 0.2 better on the core, and you can see there 0.2 better in both instances on the year over year. But hey, it's still 6.3% of the core and 7.7 year on year. The CPI getting help from lower owner equivalent rents. That's how they bring housing into the CPI, a decline in apparel and used car prices. They've said repeatedly they need convincing evidence that inflation is coming down. So while the market is all in on this lower inflation number, the Fed is likely to be more cautious. She wants several months of cooling data before he changes course. David, guys, it's been a long time since I've reported good inflation data. I'm not sure how to handle it. Well, market knows how to handle it. Yeah. Wow.
4% of the S&P, and that move in the NASDAQ right now, 5.66%. You know, Steve, there are a lot of algorithms out there that are simply based on that 10-year treasury yield. If it pierces 4% of the downside, boom, you go into buying mode. That does seem to be happening here. But again, back to your point, does this really change the end point? Do we still get the 5% or more when they're done?
Well, David, the market certainly thinks so. If you look at what's happened to the peak funds rate on Fed funds futures we went in, over 5, as you suggest. We were at 506 this morning. It had come down a recent day from the highs. And now it's trading at 483 for that May contract for the peak funds rate. Kristen Duha from Evercore ISI saying this morning that this lower than expected or better than expected inflation number now cementing the idea of the Fed coming down at least to a 50 basis point increase for the December meeting. There is something of a bit on the 25. I think that may be pretty aggressive here. Look, David, the market wants that. What do you want to call it? That all clear signal, that green signal that things are going to get better, and we're on the way to normalizing rates and a lower funds rate. I just should say we've been here before, and I feel a little positive on all this.
All right, well, just real quickly on that then. How many reports, what does make up for the Fed a satisfying group, so to speak, that they can really make a decision on?
David, you've been a reporter as long as I have, and we both know that 3 is the trend, right? If you got 2 examples of something, get on the story. You got 3, you got a story. But as you say, the market's not going to wait for that. The market's going to price in. I think what the market feels is we're down at this level, that the upside risk here is worth it relative to the downside risk of continued inflation. So I think that's really, it's a risk reward story for the market here, more so than it is a clear bet on inflation coming down. I think we can safely say things are improving. It's just the slowness of the incrementalness of this improvement that I think is a little bit concerning to the best.
Steve, thanks for that. Steve, let's continue the conversation this morning. Joining us this morning, Schwab Asset Management CEO and CIO Omar Aguilar, and Jefferies Chief Market Strategist David Zervos. Guys, great to see you both. David, let me start with you and ask, you were with us a few days ago and sort of framed this process as baby steps toward the Fed's end game. Is this another baby step or something more than that?
I mean, it certainly feels like a bigger step, Carl, this morning, 4 on the S&P and 5+ on the NASDAQ. It's a big miss to the downside. It's a lot of relief. I think it takes away from the aggressiveness that we heard in Jay's press conference after the last FOMC meeting, but it's nicely consistent with the statement. The statement was talking about lags, about cumulative tightening, and I think we're going to start to see that play more in Fed commentary, maybe more like what Charlie Evans was talking about earlier. And I think it takes us much more into this fine-tuning phase. We've done the heavy lifting. We got 400 basis points done already. We're going to have 450 or so by the end of the year, maybe 475. And we've got a lot of QT to get through. We're going to have 500 billion QT by the end of the year. So there's a lot of tightening in the hopper, and we're starting to see, the benefits that the Fed is looking for. At least some signs of them coming through, and I think the market's really going to feed off that. And obviously, that.
Yeah, definitely this morning. Omar, it sounds like maybe you are tuned in maybe a little bit more to the longer-term structural stickiness in inflation that could haunt us for years.
Yes, absolutely. First of all, obviously the market was starving for some positive light that this was actually working somehow. And I think over the last few months, we have seen the market taking so much of the negative side of all asset classes, fixed income, equities, commodities. And I think, a report that shows a little bit of light at the end of the tunnel obviously has been incredibly well received by both, bonds and equities. But long term, the pace and, the whole concept of what we're talking about here is really just, the deceleration and the acceleration of, higher rates by the Fed and central banks around the world, how fast they can go towards a more restrictive monetary policy. And at the same time, the pace of the deceleration of these inflation pressures. And, as you stated, the longer term reasons of why we got into these plays, they're still there. That is going to probably just, have a lot of questions probably closer to the terminal rates than what it is, whether it's deglobalization, whether it's demographics, whether it's overall just the overall landscape of how we move towards renewable energy. All of those costs will probably stay with us for longer than what I think officials may actually have in place.
Hey, David, we're talking about an extraordinary morning here so far, just the amount of market cap being added. I got Amazon up 10% on no news other than this, and then Apple and Alphabet and Microsoft, again, the biggest of the cap companies out there, adding 6-7%. Is this the beginning of something new, or is this a fake out?
So, David, look, I think there's not a back up the truck moment here. We're going to new highs. That's not the story. The story is that we have a very nice cushion on the downside. We've got a lot of nominal GDP growth that's been very helpful for earnings, very helpful for valuation. And we're going to push back up and see if we can get to that 4,200, 4,300 level, which I think is very doable. I do think up there, though, David, the Fed is going to come kind of, like they came at in Jackson Hole and say, look, guys, we still have this inflation. We still have this, mark on our report card that we're not very happy about. 7% in 2021, 8% going down now to 7.7 in 2022. They're gonna use opportunities of strength in the market and easing of financial conditions to just get to their goals a little bit faster. It doesn't mean they're going to tighten more. It just means right. And I think that's
all right. But I'm looking at, all right, I'm 7.7 now in inflation. I'm still looking at S&P earnings being down next year. We can debate how much, but I don't know where a market multiple should be. So I don't know. Do I want to use this as just a great opportunity to sell today with the NASDAQ at least now only down 30% for the year?
Well, because I actually think the earnings story is the thing that's really been missed by the market this year, David. Earnings have surprised remarkably to the upside. We have an economy. Think about this. Our economy nominally is generating about 25 trillion of GDP. 3 years ago, that was just a little more than 20 trillion. It's a lot easier to create $1 of earnings, $1 of profit, or have a valuation that's higher when you have 20% growth in nominal GDP in 2 years, 12% in 2021 and 9%. Even though real growth hasn't been that high. It's been almost negligible, right? 2 negative quarters. So, I think the equity community really missed in the beginning of this year the idea that this is an inflationary slowdown, not a deflationary slowdown, and they kept doing comps to what happens in deflationary slowdown, like we had in the late 2000s. Said, oh, earnings have to collapse. Not when there's lots of nominal income and nominal production. So I'm not there with everybody necessarily on this big collapse in earnings, and I haven't been all year, which is why I was never in the 3,000 to 2,700 camp, which a lot of the guys you guys had down with were sitting in for a big chunk of the meeting.
Yeah, some of them are still out there. Not to get too granular, but one thing that did stand out at this morning's print was medical care, down 0.5 month on month. That's the weakest monthly change in several decades. And I'm wondering if you think that's an outlier, was it a rounding issue, or is it a canary in what could be, I don't know, some argue a cascade effect in decelerating inflation?
Well, one would hope that, the data point will probably represent the beginning of the trend, but one data point obviously is not enough to just figure out, where the next pieces are. It is obviously, whether it's rounding error, whether it's just the actual number that represents the next, point, will obviously, represent a relief on what it is. The reality is that it's deflationary, which is great. And I think, the hope is that they will actually stick and then create a trend that we'll all can agree upon. I think that the biggest challenge in here is just, the reaction function that we're getting from all these data points by Fed, by the market participants, and by the market altogether. I think it's just, something that we have seen it even just today. Obviously we're focusing on equity reaction, but if you actually see the volatility of changes in yield, especially in the short end, it's remarkable. I don't remember seeing, that big of a change just out of one data point as we have seen. So that only shows that the
reaction function and the extrapolation of single data points tend to be overly stated at the moment.
There's a lot that would need to happen for this outcome to still materialize sooner rather than later. But if we really see an end to the conflict in Ukraine, and thus maybe some pressure on things like energy and food prices, and the other dynamic of inflation, what does that do to the inflation outlook? What does that do to the Fed outlook going into next year? What does that do to the equity market?
I mean, I think it's great news for the supply disruption story, right? That's been a big driver of this inflation story that we've had accelerate this year. Of course, the beginning, we started year with 7% inflation, but the reason we went up to over 9 is because of that war story as well as the zero COVID policies in China. The more that they add, the more that we can kind of get through this period of negative supply shock, which I think the Fed does believe is a big part of the story. It's not really for them as much of a demand shock as maybe some of the market have characterized that. So the equity reflection, big deal. It's a big deal.
That's a really good point. It's a great point, and one, Omar, I'll let you have the last word on, because there's a sense today that as some of these supply shocks get smoothed out that were related to COVID, at the very least, it allows the Fed to make decisions that aren't going to be based on a head fake that they'll regret later on. And I wonder, in that sense, if you think the Fed's path, whether they hike as much next month or not, is a little bit cleaner at least. I mean, compared to historical norms.
Absolutely. I think, the biggest part here is like these reports today provide the Fed with more options. And I think that optionality the Fed was looking for, at least, shows that their actions have been on the right track. I think whether or not they do the step down from 75 to 50, or whether or not their terminal rate, moves down a little bit from 5 to 4.75, that's probably not, what they're worrying about now. I think what they have in mind is their labor market. I think that is the biggest part of still uncertain of what is going to be, how fast they can continue to get to that terminal rate, and what is the expectations they may have and the market may have on that strength of the labor market. I think overall that sort of trade-off is sort of there. I think they have already discounted that growth will slow down. I don't necessarily they are worried about even about market volatility. So they're definitely, looking very closely at what the impact of these reports and the changes in their monetary policy and their pace will actually have on the labor market. So it's still, I think, too early to claim that there will be a change. I think the Fed has optionality, and for them, having the ability to continue doing their role of trying to fight this inflation is critical. Because remember, if numbers are lower, so they're not low. We're talking about still a 7 handle, and that's something that the Fed has very clear that they still need to have some work to do.
Yeah, that'll be a long way from 2. Omar, David, great discussion on an important day. Thanks so much.
Well, in the midst of this broad market rally, transport is just the latest sector to show signs of belt tightening this morning. C.H. Robinson is one of the biggest freight companies in the country, reportedly laying off 1,000 to 1,200 workers. CEO Bob Biesterfeld telling employees, quote, "We got ahead of ourselves in terms of headcount." Now, despite today's rally, the name's still down since reporting results last week. You can see up right now 3.5%, with the transport's also up 4.6%. But guys, I mean, we've seen it from the likes of FedEx, where just recently we had some updates about ongoing belt tightening and trimming of capacity there. So you are starting to see the question, of course, being, is it economic slowdown or is it normalization post-pandemic? You are starting to see some of these moves made within freight, which of course is an early indicator on the economy.
Yeah, Jim was talking about it earlier as being a very good sign, particularly for these rates coming down for what it means for inflation.
Yes, absolutely. Although this is an interesting one, right? Because spot rates have come down pretty dramatically, especially when you're talking about, certain aspects of trucking, but the contract rates have been creeping up because it goes back to this bigger, broader, more fundamental secular shift where supply chain is concerned, and how shippers, the different companies that are moving different goods around the country and around the world, are now moving to basically try and prevent the type of situation we've seen play out in the past couple of years, prevent that from happening again in the future, which in some ways, Carl, goes back to, and I think of you in Vietnam doing your documentary, the moves out of China too, in terms of some of the industrial bases.
Yeah, but you're right about the spot market. The fact that we're seeing the spot market come down in a period where you normally see higher retail activity is significant. That season's just not materializing the way it has in recent years.
Yeah, we're gonna have to see, right? It's peak season, but we also know some of that was pulled forward, and I think about that Amazon Prime Day as an example. Okay, well, stocks are surging as we've been talking about all morning following today's CPI print that was softer than expected. Let's bring in senior markets commentator Mike Santoli. Mike, your thoughts as we see the Nasdaq up, what, 5.5% today now?
Well, yeah, the starting point, Morgan, matters quite a bit, considering the Nasdaq was down some 3.5% from Tuesday's high. You had all the atmospherics around the crypto meltdown dragging that lower. Also, the broader market was bracing for at least the possibility of another hot upside surprise on CPI. That was clear. You had a very, very extreme put hedging going on a couple days ago, one of the most active days of the year for that. So I think that kind of released the market once we got a little bit of relief on the CPI to go back into the hardest hit areas. That has included tech. The broad market has held up. I keep, kind of going back to this point, has refused to break down over the past several weeks, despite what's going on with the big tech earnings blowups, with the Fed hawkishness, because there was this possibility that you've already priced in a lot. You've seen the overall earnings picture, not terrible, and then you have the seasonal strength if you could just get a little bit of help on inflation. It basically doesn't change the overall trajectory, but it takes some of the pressure off. Big moves in bond yields translating into that in the Nasdaq.
Yeah, I was just going to flag the big moves we're seeing in bond yields right now, but also the fact that the dollar has come off those recent highs too, and whether that is much more meaningful and whether it does speak to, and I know you guys have talked about this in the past hour, a peak in the dollar.
It looks a little bit like it could be a short-term peak without a doubt, and that was the case coming into today. Now it's, I think, further perhaps given some credence to that idea. It all does come back to what it means for how urgent the Federal Reserve needs to be from this point on. Whether we can start to bring the destination for the short-term Fed funds rate into view, and the Fed talking about how they can step down. Basically, the market has taken that sort of 75 basis point hike in December down to a 50, most likely at this point. There's more data to come before we get to that meeting. So it seems that consumer finance has struggled. We've seen consumer discretionary in general kind of left behind. It's much more about industrial, financial, sort of that wholesale piece of the economy that's working out.
Mike, we're still a few weeks away, obviously, from the end of the year, when we sometimes talk about tax loss selling, but I wonder if you think that creates a lower threshold for some to let go of gains that they've taken a beating on this year. You would think, Carl, I think you've had just a massive amount of time and opportunity to have that done already. There is always a procrastination element of it. Keep in mind, I mean, if you're looking to offset income, you can't do that much of it, right? With tax loss harvesting, but you can offset gains taken previously. So to the extent that coming into this year, in the first quarter, everything was trading at a high and you had a chance to book a lot of profits, yeah, sure, you'll have an offset to that. To me, that doesn't, it's really hard to handicap those dynamics between that and buybacks, maybe getting rekindled. I feel like that's sort of the, it operates in the background, but it's not at a trigger point right now. Downtrends remain downtrends. The Nasdaq doesn't look like it's about to turn around and leave this market higher, even if we do get, more upside than today's highs. Right.
Mike Santoli, thank you. And for our viewers that are listening and hearing a lot of applause in the background, as we do prepare to celebrate Veterans Day tomorrow, we do have World War II veterans who are on the floor right now, and that is what the applause is for. So with that, we will go to break. See you on the other side.
You need new replacement windows, but you're just not sure if they're in the budget this year, right? I'm Brian Gary here with Ted Toons from Renewable Ensign, and he's here to talk about how to make window replacement more affordable.
Well, first, Brian, you don't have to do them all. You could just replace your worst windows first. Or another way to make them affordable is to change the style of window. For example, you could do a gliding window instead of a casement. We have a lot of ways to make window projects really affordable.
Compared to other window companies, you have a completely different business model.
Yeah, Yeah, with other companies, there's just too many people involved in the process. There's the manufacturer, the seller, and then the installer, and then the customer. And if you call with a problem, that's when they say, oh, well, we're the manufacturer. You have to call the installer for that problem, or vice versa. We're the full service replacement window division of Andersen. With us, there's no passing the buck. At Renewal by Andersen, we sell, build, install, and warrant our windows and patio doors. So if there's ever an issue, we take full responsibility for it.
Why don't you sell vinyl windows?
Well, a lot of vinyl products just don't hold up well. Like a vinyl fence. When it's first installed, it looks great, but with expansion and contraction, it discolors and cracks. For that same reason, a lot of vinyl windows just won't last. Our window material is a composite that combines the best of vinyl and wood. Well, Firex is low maintenance like vinyl, but stronger than vinyl. And it's beautiful like wood, but doesn't require the upkeep of wood.
During our countdown to Black Friday sales event, buy one window or door and get the next one 40% off. That's 40% off with a minimum purchase of 4, plus save an extra $30 on every window and door with no money down, no monthly payments, and no interest for a year. Our countdown to Black Friday sales event ends November 25th. For an appointment, call 1-800-918-0808. That's really great. Thanks.
Wow, he sounds happy. Direct indexing.
Oh, yeah. Tax advantage passive portfolios that do Williams that can't. Discover custom direct indexing with Parametric. A stock and a company are not the same. You need to be able to differentiate between the two. Weak fundamentals, no buybacks, no dividends. That's a sign of a broken company. The outlook won't improve, and no level is too low to sell. If you find a great company with a broken stock, the price will eventually follow strong fundamentals. This is exactly the kind of opportunity every investor is looking for.
Get Jim Cramer's complete guide to investing for free. Scan the code or go to cnbc.com/Kramer Guide.
Walk on the street. It has been 1 year since Bitcoin hit its all-time high. Now digital assets near its lowest levels since 2020. All the crypto-connected companies and currencies are on pace for a negative week. Stock of our next guest's company is in the green today, but down 30% for the week. MicroStrategy founder and executive chairman Michael Saylor joins us now. Michael, it is great to have you back on the program, and certainly a key time to talk to you.
Yeah, thanks for having me.
So I want to start with what we have seen playing out in the cryptocurrency space more broadly this week in light of everything with FTX, the ripple effects to other assets, including the price of Bitcoin, and just get your response to what we're seeing and how it's unfolding.
I think this week highlights the virtues of Bitcoin as much as it exposes the fragility of the crypto. Bitcoin is a commodity you can sell in custody without an issuer. The vast majority of all the crypto tokens there are unregistered securities trading on unregulated exchanges, and they're fairly centralized. And so what could go wrong? Well, we saw what could go wrong in the centralized token trading on unregistered exchange flows up this week. I think that the Bitcoiners have been predicting this for a long time. Speaking for all the Bitcoiners, we feel like we're trapped in a dysfunctional relationship with crypto, and we want out.
So how do you get out? Does this enable it when you see a shakeout like this across the broader space?
Look, I think the industry needs to grow up, and the regulators are coming into this space. And what the world wants is it wants digital assets and digital commodities and digital securities, but there's no way to register a digital security. There's no clear guideline or roadmap for designating a digital commodity. The world wants $1 trillion of digital currency in the form of the USD stable coin. And so I think that the regulatory but the marketplace is waiting for the regulator to say, this is how you register digital currency, this is how you register a digital security or a digital commodity. Instead of saying all these crypto exchanges are there's greed or the mistakes, the principle of Bitcoin is you can't trust the CEO, you can't trust the company, you can't trust the custodian, you can't trust the bank, and you shouldn't have to. You should be able to hold your own keys, run your own node, and the network ought to work with no discretion for the next 1,000 years. Satoshi articulated this very clearly in the white paper. I think that it's a strong tenet of the Bitcoin community. It's a sad circumstance that a lot of people have to lose a lot of money to be reminded of these basic principles. But I think this is a teachable moment for the entire crypto industry and the mainstream industry. And it teaches you that if you're going to have a crypto asset, it needs to be nobody else's liability. You need to have full transparency to it. And that's what Bitcoin is, and that's what FTT was not.
Mike Novogratz was on our air earlier today. He actually gave you a shout out. I just want to play the soundbite.
The fallout will be far, but it's not going to stop the underlying community from holding together. Certainly in Bitcoin, in Ethereum, there are too many people invested in the success of these communities. Remember, those communities are decentralized. If Mike Novogratz gets run over by a car, God forbid, or Michael Saylor gets, proven to be, someone who's not, or whoever, Bitcoin doesn't matter, right? These centralized tokens, like Sam was FTT, it's a very different ecosystem.
I want to get your reaction to that, and also, other than maybe the price pressures or volatility we've seen on the price of Bitcoin this week in the midst of this story emerging, does this situation impact MicroStrategy in any way?
Yeah, so the reason we're excited about Bitcoin is it's something greater than all of us. We're not betting on a company. We're not betting on a team of individuals, the efforts of others. We're actually buying into a protocol which is spreading all across the earth to solve the problem. MicroStrategy is on a roller coaster, has been since August of 2020. In August of 2020, we had to make a choice or else face the inevitable descent into economic misery. So what's the result of that choice? We put $425 million of our cash into Bitcoin at that time, and we've been buying Bitcoin ever since. Here's the result for our shareholders. Our stock is up 38% as of close of market yesterday in the doldrums of the crypto crash. Bitcoin's up 33%. The S&P was 12%. NASDAQ lost 6%. Gold's down 16%. Bonds are down 21%. MicroStrategy performance beats every big tech company. We beat Apple, Google, Microsoft, Amazon, and Netflix. And so, yeah, it's a roller coaster, but our shareholders are winning. And we're going to stick with that strategy because it's working for us, and our conviction is steadfast.
Right, and we've had this conversation a number of times, and your answer hasn't changed, but you are leveraging a non-cash flowing asset, Michael. Leverage is dangerous. I don't need to tell you that. So to bring everybody up to date on where you stand on that, how you think about it.
Well, actually, our company does generate cash flows consistently, and that's one of the advantages of MicroStrategy. We have a stable enterprise software company. We generate consistent cash flows. And as for our leverage, we just have a small piece of a Bitcoin-backed loan, and we're over-collateralized for that Bitcoin-backed loan by a factor of something like 10. So we're very, very good shape on our balance sheet, and we're able to hold a distance. I mean, our other debt doesn't come due until the 2025, 2026, 2027 level. So we have adopted a responsible strategy.
ESG streams, flexible charitable giving. That
doesn't sound like an ETF.
Discover custom direct index with Parametric. We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by moving every turn with greater awareness of what's possible. Constant assessment, determining the best position, that's the perfect view. This means opportunity. You're supposed to go over the top. Every investor call on top. We change the Fed rates and the S&P. What he's wanting, what he's predicting. Exclusive market insights and opportunities. Today, watch and listen live on the CNBC app. It's not the life insurance policy for gas, so they're basically sitting on a gold line. I don't think they have a clue. But clearly, everyone knows that yourself thousands of people sell their policies for gas.
All this crap. If you want to try to $100,000 or more, you can sell all the property, double trade, even a term policy. But now, the combination of capital buffers with no future income. Oh, the trouble. That's really what I call for. You have no idea. I now have no student article with me. Well, how did you do that? You got a day and you 571, 7900, still with the public dividends.com.
Joining us now on set. Jeff, great to have you on. Rates aren't rising today, but we have seen a pretty parabolic move this year. Your thoughts?
Yeah, the real issue is whether it's rates or it's inflation of the market. When the thing happens, if it's really fast, that's when you can think slow as investors. The real challenge is the book, thinking fast and slow, the foundational book in behavioral science, that you don't want to react too quickly. And I think today is a great example. The market shot up, and if we're investing for the long term, we don't want to act on that FOMO, that regret aversion, moving quickly. Because sometimes the market, we need to draw back and think about our long-term goal, why we're investing, what it is that we're trying to achieve. And when news comes out about CPI or about interest rates or the market pops, that tends to get us all either excited or agitated, and that's when we tend to make a rational and quick decision.
Okay, so this is a big start a little bit more. I mean, the 60 days of good trigger isn't going to get it from market, right? Get out. So in terms of being able to take that emotion out of the equation, how do you do it?
There are a few tips that behavioral science people are the sort of best practices. The first is to ask yourself why. Why are you thinking about this decision? How does it serve your particular goals? Not what the noise is and other people are doing, but what excites you, what concerns you, what are you trying to achieve in regards to your portfolio? Regarding that, it's also what's your timeline? Are you doing this for short-term pursuit? Are you doing it for long-term gain? We have the World War II veterans here. Great example of the importance of long-term planning. Most investing is long-term. And the third thing is we need to remember to control what you can control. A lot of stuff is not within what you can influence. So control what you can control. And there's a little trick that I like to suggest. It's called advise yourself. Imagine somebody else came to you with your potential choice and said, hey, Jeff, hey, Morgan, what would you do in this situation? What advice would you give that friend? Because that removes the emotion of ourselves. We give better advice to other people than we give to ourselves, or kinder to other people than we give to ourselves. So if you're thinking about making money today or any time, just take a step back, think slow for 1 second, and ask yourself, what would I tell someone else in this situation? And chances are that will help you get to a little bit more rational.
Okay. So is there something rational investor is what we're talking about training to become one?
There is no perfectly rational investor, but there is a continuum. And if we can put the fear a little bit away from the pure irrationality and get a little closer to something that takes into consideration our opportunities, the data, our goals, the market, what's really happening, what really serves us, that's much better than reacting emotionally and quickly, just even more sophisticated as a possible.
Thanks for listening.
Says the president and presidency released the model in 2014. It's a very important since inception back in 2019. The interest rates will see a big downturn at one point just a few days ago. We saw the 10-year yield at over 4.2%, round base about 3.8%. Even at this rate for these the CLOs and the capital that are around so if they some of them are actually the chart line that it's just inverse relationship. One of them is sort of like which means that really benefit are talented. Snowflake with the valuation over the past 4 years. They're the best in many times the PSI ranges. They're about more than 90% right now. We're talking about system. I'm not seeing that same thing. They don't have that same thing with the interest rates on the 10-year yield right there, one of the major factors for these stocks.
啊，
point on it. Laid off yesterday, provided this video to NBC News.
I'm the founder and CEO. I'm responsible for the health of our company, for our direction, and for deciding how we execute that, including things like this. And this was ultimately my call. And it was one of the hardest calls that I've had to make in the 18 years of running the company.
Robert Nathanson was an outperform rating on the stock, saying yesterday's announcement that they were slashing 13% of the company's employees closed with a clear affirmation that this is a rational company led by a CEO who cares about his share price and what investors think of his leadership skills, saying that the slowing down in core cash operating expenses should stabilize the recent collapse of family apps margins and cash flows. Other social stocks also surging today, Snap up 4.5%. Snap up 5.5%, Pinterest up nearly 7%. You're also seeing the other ad-supported players move higher. Spotify shares up nearly 9%. Alphabet shares up about 7%. Also, take a look at shares of Bumble. That stock rebounding after initially falling last night, following a weaker than expected earnings report. That stock is up about 7%, while Master shares are up over 12%. John?
Yeah, it's happening fast today, too. Thanks. Now, here are these updates from Bertha Coon. Bertha.
Hi, John. Here's what's happening at this hour. 2 days after millions of voters cast their ballots in the midterm elections and control of Congress remains undecided, NBC News projects the GOP will regain control of the House for Democrats, while the Senate hinges on a few tight races in Arizona, Nevada, and Georgia. President Biden will meet with Chinese President Xi in person at the G20 summit in Bali next week. The highly anticipated meeting will be the first time Biden sits face-to-face since taking office. This time, Russian President Vladimir Putin will not attend the summit, preventing the chance for him and Biden to meet for the first time since Russia invaded Ukraine in February. And Hurricane Nicole making landfall in Florida's Atlantic coast last night, causing widespread power outages and potentially widespread storm surges. The rare November hurricane weakened into a tropical storm as it made its way over east central Florida, bringing continued strong winds and heavy rains. Hurricane season doesn't end until December 1st, Carl, but it's rare to see something like this in November.
Yeah, water's still warm. Thank you, both the crews. We're a couple hours into trading this morning. Markets obviously getting a massive boost from this morning's cooler than expected CPI print. Let's bring in CNBC senior markets commentator Mike Santoli talked about the price action. It's interesting. After the print, there's plenty of opportunity for Fed officials to come in and pour cold water, but hasn't had much of an effect. Not yet. I think it would only happen in a scheduled way. It does fit into the general scheme of, look, we've done a lot of tightening. We're waiting for the data to follow along because it lags. But just the size of the moves outside of stocks, I think, are worth observing. 2% drop in the U.S. dollar index, massive decline in treasury yields across the curve. It shows you that this is a massive tension release type move. People bracing for yet another upside surprise in CPI. Almost every single CPI report of the last 12 months has been an upside surprise. So that's why I think you have the magnitude of the move, and then you set up with the declines yesterday. And the real extreme action happening in the most beaten down, heavily sorted parts of the market, the disrupted tech basket that have been going down for the better part of 2 years. Right. The dollar point's a great one. We were at 114 on the DXY, 108 today. VIX has gone from the mid-30s at the worst of it to the low 20s now. It hasn't been one of those really steep drops where you had a perfect spike on the chart. What you had is a grudging one. People realizing the market is not buckling and making new lows, staying in a range, but still, we had the CPI number, or we had the Fed. There was always something where it was going to create another hazard. And of course, the lows for the VIX this year has occurred generally at 19, 20 in that range. So maybe there's more downside. I think it's much more just telling you what we're seeing on other screens as well. It's not really predictive at these levels. And then you have the tech piece of it, which is the extreme underperformance of the NASDAQ 100 relative to something like the Dow on a year-to-date basis, and tech versus energy or something like that. So I think that's why you get these real quick silver rotations into stuff that has lagged to that. Don't go too far. Let's go for more of a market rally. Let's bring in Wilmington Trust Megan Shu joins us today as we now have 1,000-point gain on the Dow. Megan, welcome back. Good to see you.
Thank you.
During the dark days of October and maybe even earlier this month, your advice was to stay invested. Does that hold? And given some of these opportunities today, do you make some decisions based on that?
Yeah, Carl, thank you again for having me. I think the inflation data today was very significant. As Mike pointed out, we've had a series of upside surprises, so it's nice to get a downside surprise. And I think that this helps to confirm one leg of the Fed funds puzzle, if you will. There's the pace, there's the level that we're going to, and then there's how long we're staying there. So I think this confirms what we heard from the Fed last week, that the pace is likely to slow. What we still don't know is where that peak Fed funds rate lies, and how long the Fed is going to stay there. Typically, if we're talking about softening growth, we expect rate cuts. We're starting to see that getting priced back into the market. I don't think the Fed is really going to want to see that. You know, they've really tried to despite over-communicating, they've tried to pull back on some of that forward guidance, which doesn't really have a great place in today's uncertain environment. So I don't think we're going to get a lot of dispersion one way or the other. But it is definitely fueling a balance in some of the more oversold parts of the market.
Yeah, Megan, a 12-point move on the Dow. You can zoom 3% higher, which is significant. And then 6% upward move on the NASDAQ. I have a hard time remembering the last time we saw that, so the day is not over. How much of this do you think is because of new information? How much of this is a snap of the rubber band based on what we've seen happen in the day's price?
I think it's both. In terms of the snap of the rubber band, as you put it, we know that the growthier parts of the market are very oversold. They're looking attractive on a valuation basis relative to their own valuation and relative to other parts of the market. And we know investors have been very defensively positioned, holding a lot of cash, being underweight to these beaten up parts of the market. So to see some reassurance, I think rates is a huge part of this, driving the market today. See rates come down and the 10-year back below 4%. You're seeing that rubber band snap back. But at the end of the day, it still comes down to the growth dynamic. And if we're looking into 2023, we still think growth is likely to slow significantly. Actually, we revised our base case to expect a mild recession in 2023. So I think you have to be focusing on parts of the market that can generate growth, as well as keeping an eye on valuations, because I don't see rates coming in significantly from here to fuel much more of a rally in those very highly valued parts of the market. Right, and I'm going to essentially when you were talking about the three pieces of the puzzle, it feels like the two most important parts, that is the level that Fed rates are going to and how long they're going to stay there, still remain unchanged, or at least unchanged, right? So what do you recommend to, you know, the retail investor right now thinking about getting in now or selling on the top? Well, we have had a useful allocation to equities versus our strategic benchmark, favoring the U.S. over international. And I think days like today, you know, despite some of the weakness in the market and how much pain we've experienced so far this year, days like today are a reminder of why you have to be invested. The market is going to move very quickly on positive data, and it's probably going to sniff out an improvement in the trend of inflation as well as the economy well before the market does. And even if we do expect a recession in 2023, if it's the first half of the year's story, we could very well see the market bottom and start to show some real momentum in the early days of this year, or even the back half of this year. So we're staying patient through volatility, but staying invested. We do have a little bit of extra cash that we are being patient on and looking to put to work. I don't know if today's the day to do it, but you know, if we do get some further evidence on the real-time, more fast-moving data that inflation is starting to slow, it could be a real opportunity to move to an overweight on that.
Interesting. Finally, on crypto, Megan, there's two basic schools of thought. One is that it's the lines between the crypto system and the legacy financial system are much thinner than they were in prior crises, and so there's some separation there. But there's also the prospect of would-be margin calls and what JP Morgan calls a cascading event that could lead to certainly lower prices in crypto and maybe vulnerability for equity. What do you think?
Well, you don't know what skeletons are in the closet until you open it up and turn on the light. So I think it's definitely possible that there's more vulnerability and more risk underneath the surface than we realize. But I don't think we're seeing signs of evidence yet that there's broader contagion. Certainly some linkages and higher correlation between crypto and some of those growthier, more highly valued parts of the market. But I think that's probably just because those investors tend to move in the same circles. So there's maybe some pessimism and risk taking moving off the table there. But for now, we don't see broader contagion risk in the crypto space. But of course, tightening financial conditions, removing liquidity, you tend to see some of these fractures in the surface.
Right. So that's why we're paying so much attention to it, despite its relative size to the equity market. Megan, as always, thanks so much. Good to see you. Thank you, sir.
Thank you, Carl.
Yeah, speaking of that potential risk canary in the coal mine, let's talk about FTX some more. Some of the biggest changes in crypto weighing in this morning. Galaxy Digital CEO Mike Novogratz. Or no punches talking about Sam Bankman Fried with Squawk Box earlier.
It's unbelievably frustrating that, we basically have a situation that looks like fair enough. Looking back at all these red flags, and you're like, I kept asking myself, where is he getting all this goddamn money? Excuse me cursing. Where is he getting all this money to be buying these things?
Novogratz pointed out that he's got millions of dollars tied up in there. We also heard from MicroStrategy Executive Chairman Michael Saylor offering his take on what this means for regulating crypto moving forward.
I think the industry needs to grow up, and the regulators are coming into this space. And what the world wants is it wants digital assets and digital commodities and digital securities, but there's no way to register a digital security. There's no clear guideline or roadmap for designating a digital commodity. The world wants $1 trillion of digital currency in the form of the USD stable coin. And so I think that the regulatory intervention of late has been all negative, like enforcement, but the marketplace is waiting for the regulator to say, this is how you register digital currency. Well, remember, he's Bitcoin, all Bitcoin. This is not taking him off of his bull case. He says Bitcoin needs a way out of its dysfunctional relationship with the broader crypto landscape. I think now we look ahead to the next milestone for what happens to risk. I don't know whether that's the holiday numbers, the initial numbers that we get, whether they're weaker, whether they're stronger than expected, what that means for inventory overhang. I'll keep going back to inventory for much of the year. I think it's a big issue. But the market response today, it's really some breathing room for those who like risk.
Yeah, it is a wild market day. The Nasdaq 100 up 6%. And, in the crypto landscape is doing well today, going what's been happening over the last few days. But I think, everyone that seems to come on air is talking to us still about regulation, Paul. And I understand that the U.S. is arguably more regulated than other places. But that's sort of why this is happening. You can't make a lot of profit here in the United States if you're a crypto exchange. So you have to go internationally. There's not enough regulation internationally to make sure that those aren't commingled, that they're not leveraging their balance sheet over there. So it's kind of lose-lose. Where does the U.S. end up in here? Gary Gensler this morning, the SEC chair, he didn't say a whole lot because I just wonder if there's not a lot that he can do. FTX US was a part of it, but it's going to be impacted, Bob.
That's a great point, especially when you got entities that have basically gone regulation shopping around the world for the better part of the year. And maybe it's not so much that the SEC can't do anything at all, but certainly it's very difficult to do things that are hurry.
Yeah. And speaking of the next, domino, perhaps watching stablecoins very, very closely. You saw Tether wobble a little bit, but largely keeping its peg. There's always been questions about those reserves, which are not audited, not super transparent because they're not audited. morning, take a look. Our own Steve Kovac is here with the latest. Steve.
Hey there, Dee. Yeah, these gaming is coming off a really tough earnings season, so but they're glued today along with so much of the other market. Let's talk about what we're seeing. Electronic arts up nearly 3% after reporting earnings last week. Activision up 2%. Now, this is a big move because that's mostly trades on the Microsoft acquisition, which is not expected to be finished until June of next year. And it's also breaking sales records with that new Call of Duty game, over 1 billion in sales so far. That's a hot game. Take-Two Interactive up 4% after that big drop Tuesday following its earnings and revising guidance down for the rest of its fiscal year, due in large part to a weakness in mobile gaming. Roblox, a very similar story, up 6% after missing earnings expectations a couple days ago and showing a fall in user spending within the game. Now, overall, guys, what we're hearing about gaming, the gaming industry out of these earnings, they're lacking those really tough comps that they experienced during the COVID lockdowns and all that growth they saw during the 2 or 3 year period, but they are above where they were pre-COVID. So gaming behavior is kind of normalizing now post-COVID lockdowns. John, I'll send it over to you.
All right, Steve, thank you. Another stock surging in today's rally, Unity Software, higher by, let's see, I don't want to, 28.5% after reporting third quarter results. Unity also completing its merger with Iron Source earlier this week. Joining us now in this exclusive interview, Unity Software CEO John Michello. John, I want to get into the quarter and especially what happens with the app ecosystem going from here. But before that, I want to give you a chance to respond to the Bloomberg article that's out, focusing on you, including on your relationship with the former head of HR. Some investors might have questions about the way you're managing the company. What's the kind of discipline that you intend to bring to the company from here compared to how you've done in the past?
Well, look, I think there's really strong discipline in the company, and there always has been. But the article is really false and misleading, and I really wouldn't want to comment on it because it's really not worth it. I would say, though, like, comments like culture and discipline, we've been doing, very important, rich work around surveying our employees around with anonymous survey to understand how people think about the culture. The numbers are, top tier, top 10%. It is, a really strong culture. People trust in the culture. One of the values that we talk a lot about is in it together. People use that expression to describe how strong we are as a team. Again, it's hard to comment on something false and misleading. And what I'd really love to spend more time talking about is, we just reported a quarter where our creative business was up 54%. Now we are dealing with some headwinds in the advertising business as everybody is right now, but we've got a really strong setup there for growth in the future.
Well, it's also what I wanted to talk to you about, especially since the Iron Source merger and acquisition is complete now. To what degree does the slowing consumer spending affect not just the advertising environment, but also the demand for the kinds of tools and data insights that you're offering through this? Does it intensify the need for those tools, and thus is it a tailwind for you, or is the overall slowdown in spending in that area going to be a headwind?
But as Steve commented a moment ago on the show, though, it is a really interesting time to compare, gaming-centric stocks to a year ago when COVID had things lifted so high. But at least for us, 54% growth on Create, part of that's M&A driven, but it's 30% organic. That is really strong. And we're not seeing any flagging there. I can't say that anything is permanently economy resistant, but I think, things are gangbusters in gaming and beyond gaming. If I look at the ad side of the business, there's no question that at this moment in time, there's some conservatism on ad buyers. They're looking at, quicker payback periods, spending less. None of these things last forever. I think it's a little bit of a slowdown, but here's the point. The merger with Iron Source is really the only end-to-end platform for the kinds of things that can help the developer make a better game, a better application, and monetize that game or application better. And for that, we're really saving them money and building their revenue. So reticence to save money and build revenue is something no one said ever. So I feel really confident looking forward.
John, speaking of what's driving market for developers, I want to get your take on the deal in the gaming space. It's getting an awful lot of scrutiny about its, of course, Microsoft, Activision. In your opinion, would that be good for developers and competition?
Well, I think for first off, I think some of the intellectual property at Activision, whether it's Call of Duty or some of the most incredible intellectual properties coming out of Blizzard, and then King, it's an incredible portfolio. Look, I think one of the things that's been true about gaming, and I've been listening to this, 25 years now, is there's always another big acquisition, and then what happens right after that is the next great company comes from nowhere to establish, great franchises. I could give Roblox credit for that. Years past, I could give people like Supercell. I can remember, when early days of Take-Two, look at the one franchise company. Look at the incredible success they've had around their basketball franchise and GTA. There's always the next rising star company in the gaming industry. I don't think that's going to stop.
John, are you benefiting from what I'll call early metaverse spend? Mark Zuckerberg is spending a lot of money trying to create this market that is a ways off. And I wonder, is this the equivalent of China building these cities that nobody's living in? There's money clearly that would be going into construction equipment and paying laborers and whatnot, but there's not necessarily the payoff on the other end, and eventually that spending has to drop off. So I wonder if there's any of that perhaps shorter term revenue that might not turn into continuing revenue that's going into community or other.
That's a great question, and I have to tell you, the hype cycle around the word metaverse is one of those things that gets me to roll my eyes. Sometimes, there's a point there cracks in the back of my head. There's a lot of hyperbole there. When we think of that world, what we're thinking about is the next version of the internet where it's real time, it's 3D, and in the community, we describe that as digital twins, and they're real time digital twins. Now, I remember when we went public, about 2 years ago, we said within 5 years that business would be out. It's already 40%. And so it has gone, frankly, really gangbusters. And what this is about is, like Orlando wanting to build a digital twin to manage their city better, or airports doing the same thing, or, luxury goods players trying to get to that digital triangle they think is, key part of their future, or factory floors and digital twins and IoT data coming in so they can manage it better, or visualizing things that would otherwise be buried in a blueprint or an architectural program. And so my sense is it is 100% true that most of the internet by the end of this decade is going to be real time in 3D. And what I mean by real time, it won't be a video or it won't be a photograph. It's going to be something you interact with and it changes as you interact with it. It's incredibly powerful. I think we've all done ourselves a disservice by latching on to two great books, Ready Player One and Snow Crash, that put the words out there and gave us a science fiction view that has some truth to it, but an awful lot of hype. Think of this as generation of the internet.
I hear you. We'll see if that vision has legs. Dr. Patel, I appreciate it.
Thank you.
Stocks continue to surge this morning on the heels of CPI. Let's get over to the NASDAQ, check in with Christina Parts and Nevelos, get a market flash. Hi, Christina.
Hi, Carl. So this 6% swing right now on the NASDAQ seems pretty much a sign of relief after the CPI index came in cooler than expected, like you mentioned. There's been tension in tech just over the past few days over the crypto meltdown and investors bracing for a hot CPI number, which didn't really happen, and that's causing a huge swing down in bond yield. Fed Chair Powell, though, keep in mind, did say he needs to see a multi-month string of numbers like this before shifting policy. Still notable, the NASDAQ itself is down about 30% year to date. Let's talk about today's movers. Biotech firm Seagen, the biggest lagger on the NASDAQ after appointing a Novartis executive as its new CEO. You got other health tech names in the red. They're the only ones, but 3 right now on the NASDAQ 100. But everything else is in the green. Mega cap tech, the most on the NASDAQ. 13%, 6% right now. Those names helping. Happy Woods RPTF, which is up 11% right now, but still down. Oh, it's up 13% right now, but it's still down about 2% just over the past 5 days or so. And then chips seeing the biggest turnaround on the heels of Taiwan Semiconductor posting its second highest monthly sales numbers in October. Those numbers were just released this morning. ASML up about 13% after upgrading its 2025 forecast and announcing a new buyback program. So that's helping the sector as a whole. Christina, thank you very much for the mention too. Amazon, getting closer to reclaiming that $1 trillion market cap level. We'll take a look, the venture capital angle following amid the FTX fallout, it's like capital telling its limited partners, lock right into the brain.
他说怎样猛吧，今天对呀，我们也涨了啊，意外啊，今天涨1000点了，今天对。主要是今天通货膨胀的数字下降很多，就8.5不是报结果吗？8.5报结果的时候，它那个通货膨胀数字就是差很多。
We're seeing used car prices, we're seeing layoffs all over technology and media. So I think we're going to just have a little bit less volatility, but where the puck is going is, yeah, things are slowing down, and then take a beat, wait, things are really slowing down. So I hope we get a month. I hope we get a month to 6 weeks before we start worrying about, well, wait, how fast is it slowing down? But it's a big change, and I don't think that we should try to pour cold water on the meaning of this. I think it's very important psychologically for the market that there is this sense that we're past peak inflation. Still tons of inflation, but well past peak inflation, and all of the trends are now going in the same direction at once.
So, Jason Snipe, does this open the door to a significant year-end rally? Let's call it over the next 6 weeks, as Josh said, assuming there are no shocks in between. Does it do that?
Yeah, I think obviously these numbers were very positive today. The market responded, tremendously to the numbers. So what I would say about, just kind of looking ahead, looking to the Fed and potentially in December, 50 basis points, starting to be priced in. We saw some dovish commentary for some Fed speak today. Harker talking about a terminal rate at 4.5 and maybe pausing. The dot plot, has a terminal rate under 5 now, but 4.5 is significant. And then, other less hawkish speak from the Fed. So as I look to the market, I look at what could potentially go over there, and Josh already alluded to it. I mean, home prices are falling off the table. Used car prices have come down some. So there has been some deceleration in inflation. And I think that will show up in some of the reports, some of the earnings reports as we look to going into next year. So I think the market can, and then we got an election, result that wasn't exactly a red wave, but we do have gridlock. So there's a couple of catalysts here that I think will push the market forward, definitely in the near term. So I think that's what we can see here.
Rob, your research team over at New Edge has been more negative of late over the last, let's call it several months. Cameron Nelson comes on Overtime a lot and has articulated that view, including yesterday. Does this make you guys more positive now? And if not, how can it?
Well, I think in the near term it does, because slower hikes and lower terminal rates causes bonds to rally, and it causes the dollar to drop, which is near-term bullish for equity. In addition, we're right at a critical point where we may break through 3,900 on the S&P. That has been a key resistance level. And in order to make a run to the 200-day moving average, which is 4,100, we think you need to have some of this positive momentum. And of course, seasonally, this is a strong time. And Jason already mentioned what happened in the midterm. But let's say we get to 4,100. We think at those levels, valuation becomes a ceiling. And that's even if earnings are flat next year, which right now earnings are still expected to grow. If you look at the S&P on flat earnings at 4,100, it trades at 18.6 times. Now let's say this deceleration that Josh talks about. By the way, we're still in a downtrend, okay? We are still in a downtrend, and earnings are going to be decelerating. And if you get a mild recession, you could see a 10% earnings decline, which means the S&P at those levels trades at 20.5 times. I think we are in a place where we should be having investors take advantage of this move higher. It's why we've stayed invested in quality. It's not like we're not invested. We're cautiously invested, and that's paid huge dividends for us. But at that point, I think you have to think about repositioning because bonds have become infinitely more attractive from a price standpoint. So now play an important role in portfolio.
You say investors should quote unquote take advantage of this move. That says to me, investors should sell into this to reposition their portfolios. Is that how I translate that?
Yes, I don't know if it's this level right now because I think we have some near-term momentum that may allow us to break through to the upside a little bit higher. But you have to be mindful that, again, valuation is a ceiling. And if you're a fundamental investor and you recognize the fact that we are still in a downtrend until that is broken, and what is going to break that? A Fed pivot is going to break that. And we've got to agree with you. The Fed pause probably doesn't break that. Okay, in order for us to get to the 4,800 that Tom Lee's been talking about, you know, he's been really right on what's been happening in inflation as our head of research, Bill Inglis, is flowing over faster than most expect. It doesn't cause a pause or doesn't cause a pivot. And in order to just
So on that note, though, Josh, I mean, does this reverse the narrative now that's been trying to gather steam that these stocks were dead in the water for a bit, that the game had moved to value stocks and that the action was over here for a little bit? Maybe this reignites a trade that people have loved for years.
Yeah, I want to be very careful about, talking about one day's action and then trying to extrapolate that out into something that it's not. Growth, look at Vanguard Growth, VG is the ETF, up 7% today. Vanguard Value, DTV is the ETF, only up 3%. That's remarkable, but it's one day. And even the Dow, where the Dow opened this morning, it's hard to believe given how negative everything's been all year. Where it opened this morning, that would put it at only a 7.5% year-to-date loss. So like for all of the consternation over the market, the economy, inflation, this, that, to have the Dow be down less than 10% on the year, which is the case right now, is amazing. And the reason why that's possible is because that pivot from growth at any price to growth at a reasonable price, all the way down to, okay, you know what? I just want the quality names that have good cash flows, that aren't dependent on crypto or whatever. But that being the bigger trend, I think is still in force. So I would not look at today and say, I want to go crazy on consumer discretionary and semiconductors. I don't think that's the right move. I think the right move is to